Here's your money briefing for Monday, May 22nd. I'm J.R. Whalen for the Wall Street Journal. Starting next year, the amount that people can contribute to their health savings account will rise substantially. WSJ personal finance reporter Ashlea Ebeling is with us to discuss why this largest ever increase is being put in place and how it can help you manage your medical expenses. So first of all, Ashlea, what is a health savings account or HSA, and what does it allow people to do?
An HSA is an account that you can pair with a high deductible health care insurance plan. So if you pick the high deductible plan, you can get this HSA and it helps take the sting out of having the high deductible. Basically, you get an immediate tax benefit just from putting money into the account and pulling it out immediately to spend on healthcare expenses. And there's an added benefit. You can invest the money and hopefully see it grow before you spend it. Some people who've been contributing to the accounts have built up balances of tens of thousands of dollars.
So how does somebody open up an HSA?
Typically, you do it through your employer. When you sign up for your health insurance, you would sign up for the HSA at the same time, but you can also just do it on your own.
So you don't have to be working for an employer to have an HSA?
Right. If you're self-employed, you'd have your health and high deductible health care plan, and then there's a list of HSA providers. And if you're doing it that way, it's really important to look at fees and what their investment options are.
So starting next year, the maximum HSA contribution will be $8,300 for a family and $4,150 for an individual, and it's even more for people 55 and older. Why is the IRS ramping up these contribution levels so much?
So basically, Congress set the base contribution limits and said they should be adjusted for inflation. So every year the IRS looks at that and tweaks the contribution limits based on inflation. Obviously, inflation's been really high, so the limits have gone up. And typically, the bump's just $100 or $200 a year, if at all. Some years it's zero, but because of high inflation, this year the family maximum limit went up $450 to 2023, and then next year it's going up $550 for 2024.
What kinds of medical expenses are typically eligible to be paid for by an HSA?
If you're paying out-of-pocket medical expenses without an HSA, you're paying too much, or you're overpaying, basically. So Medicare Part B premiums would count. They run almost $4,000 for a married couple with income up to $194,000 this year. So that's a big one. But for everyone else, it's all deductibles, all co-pays, vision, dental, hearing expenses, even long-term care, even things when you go to the drugstore like sunscreen.
But can't people tap into their 401k or their IRA for medical expenses? How is this different?
So you can tap into 401ks and IRAs, but that's not until you're 59 and a half when you're older. The point is now with the HSAs, you can use it for the everyday expenses now and save money. You're contributing on a pre-tax basis. There's no tax going in. There's tax-free growth and tax-free withdrawals whenever you take the money out. So it's really a triple tax advantage account. And financial advisors see the HSAs as a complement to your 401k IRA in the sense that you can keep the money there and have it grow and then use it for retiree healthcare expenses. So there's that, give and take. Depending when you need the money, you can take it out earlier or later.
So from an investment standpoint, in the way that you would invest the money in it, how does an HSA differ from, say, a 401k?
So typically with a 401k, your employer will have a lineup of target date funds or other options that you can invest in. And there's a default investment they would put you in. An HSA is different because in most plans, there's a deposit account, just a checking account to start with. And then once you reach $1,000 threshold, then you can start investing. So you're kind of driving the investment lineup more with an HSA. It's up to you. You really have to pay attention to it to make sure you're investing. Because I talked to one HSA account holder. He retired. He had actually accumulated $26,000 in his HSA, but it had just been left in that checking account, basically not earning any interest to speak of. And then now that he's retired, he's paying attention to it. He's rolled it over to Fidelity, where he's investing, earning 4.5%.
There's a lot of acronyms we're talking about here, Ashlea. How does an HSA differ from a flexible spending account or FSA that a lot of people have?
So the big difference is this idea that the HSA is yours to keep even after you leave an employer. So it's a long-term account. FSAs have much lower contribution limits and you lose them when you lose your employer. They're basically annual accounts. You can roll over only a limited amount from one year to the next, if at all.
And what happens to the health savings account money you have, HSA, at the end of a year, at the end of a calendar year?
It's there. It rolls over. It's like your 401k. If you've been invested, you might see the balance going up and down, but you don't lose it.
That's Ashlea Ebeling, personal finance reporter with us. And that's your Money Briefing. I'm J.R. Whalen for the Wall Street Journal.